To sign the contract, I can get that done for you, but the lender, the private money lenders are going to want to know.
Auction.com.
Auction.com. Okay, everybody, are you listening? All right, how many people in the room are familiar with Auction.com? Raise your hand. There you go. All right, good crowd tonight. All right. Well, I wanted to tell you, for those that are not familiar with us, we do auction. We're the largest auction house in the country, and we do auction properties on the courthouse steps the first Tuesday of every month. And also we have an online auction that happens every week. So if you will go to our website, auction.com, if you have not created an account, you can do that. And you will have access to all of the properties that we are going to auction. We do lunch and learns, we do seminars. Our next lunch and learns for the December auction will be in Cobb, which will be at the Piastra restaurant, which is right across the square from the courthouse. And then at DeKalb, it will be at Cakes and Ale. So we'd like to encourage you to sign up on our list, because we do actually have to send you an invitation, and that way you can RSVP and come and join us. Wanted to also give you the figures from the October auction. Cobb brought 17 properties to sale and sold 15 for $2.4 million. DeKalb brought 24 to sale and sold 22 for $2.6 million. Fulton brought 20 to sale and sold 17 for $2.8 million. Gwinnett brought 16 to sale and sold 16 for $3 million. Clayton brought 14 to sale, sold 12 for $1.1. So that was a total of 319 brought to sale, 179 sold, for a total of 22.8. So thank you very much. We're also going to have a drawing. Whoever hasn't put their business card in our bowl, if you'll go ahead and do that, and then we're going to give away 2 of our little binders and our new pens. So we'll pass it around. We'll go ahead and let the next person speak, but we'll pass around the bowl so that you can still put your cards in. Thank you.
Thank you, Gloria. Good evening, everyone. My name is Michael Braswell. I'm the owner of Braswell Capital Solutions. We are a full-service lending brokerage, which means we help you find, fund, fix, and flip your properties. We do obviously rehab loans. We do rental loans, low-doc commercial loans. We don't ask for tax returns, pay stubs, or W-2s. We lend in the name of your LLC, and we don't report your loans on your personal credit. So we're really designed for the real estate investor to build your portfolio as quickly as possible. We can close in as little as 7 days on a rehab, 21 days on a rental. Rates on flip start between 10 to 15%. These are 12-month interest-only loans. On the buy and hold, rates start at 5%, and they go up from there. We have 7-1 arms, 5-1 arms, and a 30-year fixed. So pretty much wherever you are on the real estate investing spectrum, we can get your projects financed for you. So please give me a call, and if you'd like, raise your hand and I give you one of my flyers. If you got a deal that you need financing for, let's talk, and let's go ahead and get your project funded for you. My phone number is 770-854-2194. Thank you. And I'm also having a drawing as well. So please, if you hand me one of your cards, I'll be sure to do that drawing. Thank you.
Hi, my name is Gary. I'm with Jenkins Construction LLC, a construction company. We do all phases of construction, renovation, repairs, remodel, build new. We work with investors. We also specialize in soil erosion and water and environmental conservation. We're licensed to do that along with our construction company. If you have any construction needs, you can reach us at 770-601-5654. If you raise your hand, I have some cards. I'll be more than glad to pass them out. Thank you very much.
Good evening, everyone. Hello, is everybody here? Everybody awake? All right, all right. Hi, my name is Bill Hampton. I'm the owner of Hampton Tax and Financial Services. We're a tax return and financial planning firm. We work with real estate investors to save you thousands of dollars on your taxes. Now, I know you don't want to talk about taxes right now, but it's coming up. So, anybody like to do their own taxes here?
Oh, we're talking about taxes tonight.
Okay, all right. Well, if you don't like to do your own taxes, I work with real estate investors. Not only do we do taxes all year round, we also do tax planning. That means we suggest tax saving strategies to our investors. If you're not working with an accountant that's suggesting tax saving strategies to you, you need to get a new accountant. My telephone number is 404-482-3170. Again, 404-482-3170. And I'm also an accountant as well as a real estate investor myself, so I know what deductions that you're entitled to. If you raise your hand, I'll be happy to pass you some business cards.
Hi, American Family Insurance. Someone asked me here already this evening, how come you guys are so low? Really, what's the deal? American Family Insurance they work like a credit union. So they're what's called a true mutual company. So by having policies with American Family Insurance, you own American Family Insurance. So that's why they do business a little bit different than everybody else and why they have some better rates. And then if you do have a claim, that's also why you get such great service on the claim as well. For instance, we just had somebody from Georgia RIA that wrote a policy with us this morning, $125,000 landlord replacement cost policy. $2 million comes standard on every American Family landlord policy. He got loss of rents, he got medical, and then of course all the perils included in the policy. $512 for the whole year. So think about that. That's a pretty tremendous price. So think about your buy and holds. Think about your own personal home. If you haven't priced it lately, somebody just came by the table just a few minutes ago, and they were with Travelers. Well, I know that Travelers is absolutely knocking people's teeth loose right now. So you may want to shop us. You may want to take a look at personal home and personal auto, and as well as your buy and holds. And remember, when you do your buy and holds, or you have any kind of relationship with American Family Insurance, you can call us up at any time, and we will do your flip properties. We will do that vacant express policy for you that you're only going to keep for 3 months or 6 months or whatever, that nobody else in the right mind wants to write it for you, okay? We're going to write it for you because you got a relationship with us. American Family Insurance.
Good evening all, my name is Emmanuel Carrillo. I am with New Western Acquisitions. We primarily do wholesale at a very large scale. We do about 30-35 transactions every single month. Properties ranging between $50,000 to $500,000. We really just find very good deals all over the city and just pass on the savings to our investors. So if you need some properties, that booth back there, come talk to me.
Okay, we're gonna pick a winner. Hey, anybody, Mr. Opportunity, put a card in? Okay. Stephen Young, North Georgia Moving. Come claim your prize. All right, guys, this is my first night emceeing, so you'll have to bear with me. If I get into trouble, you might hear a joke about a bear and a rabbit, but we'll try to make it through this. At some point, I need to call up the success story, but first we're going to go over some upcoming events. We've got a December meeting and holiday party coming up, and a do-it-yourself credit repair class. Kind of excited about that. We're going to show you guys how to increase your credit scores. A lot of it comes from throwing money at things, especially paying down accounts. We have, I'm going to introduce our contributors. We've got Sean Sheristani. He's a broker and Juris Doctorate, and he is familiar with threatening people to fix your credit if all else fails. We've got Doug Dean from Schaeferton Dean. He's a tenured partner of the firm and one of the founding members. And we've got Martin. He just goes by Martin. He's a famous guy. He's just known as Martin. He's with Royal Pacific out of California. They're a wholesale lender. They do a few $100 million a month. He can tell you a lot about the secondary market. We are doing a tax preparation class, which should make you familiar enough with your taxes to know that you shouldn't be doing them yourself in most instances. But it's good to have a handle on it so that you know when someone's not doing their job. I encourage people to take tax preparation classes, then not prepare your own taxes. So if you follow that suit, that class is going to be a good fit for you, especially if you have complex returns, 1120S's, Schedule C's, and you want to know how to take advantage of things. No matter how good at taxes you ever get, you won't really know the detailed things like when to apply a passive loss to passive income and things like that. You know, I'm pretty good at taxes, but I don't even know what happens there. We've got a coaching program, 90 days, begins January 20th. Find it, flip it, cash it, good stuff. Fast Start Boot Camp. Kurt, you want to do this? You want to do this? You think you're familiar with this stuff. Go for it.
So who wants to make money wholesaling in here? Raise your hands if you want to be a wholesaler. Girgis has found one of those rare gems to be the coach. LaShannon White earns her living, supports her two daughters, single mother, wholesaling. Who else but to have a wholesaler who supports themselves be the coach? LaShannon is absolutely great. And we're going to be starting that sometime in January. So sign-ups will be starting in December. Watch the website. So now that you know that we have professional coaching here for you for a 90-day coaching program, put it on your personal to-do list. I've been part of it. It's a great program. Thank you, Rick.
Now, you do the member benefits, correct?
Yeah, but it's...
Welcome back, Kurt Smith, member benefits.
I get from Home Depot 2% rebate because of my rehabbing of my rentals. 2 gift cards from Home Depot, one in January, one in July, that has about $600 on it each. That's what I make from my 2% discount. Off the 20% paint discount, Bear's website says I saved $600 this year. Who else here would like to save that kind of money on buying from Home Depot who's not currently getting it? Who's not signed up with Home Depot right now? I want to have you signed up and getting those discounts. You got to be rehabbing, you got to be buying paint, but if you are buying paint and not getting the 20% discount, your membership in Girgis gets you that discount. So I'm going to walk around, raise your hand, and email me, and I will help you get your account set up.
Thank you. time for our success story. Mark Pauly, come on up. Steve, are you gonna, do you have any role in this, Steve? No? Okay.
Success stories are Georgia REIA members who have done some deal in the last 30 days that we'd like to highlight. Who in here who has done any real estate transaction, buy, sell, rent in the last 30 days? I have. Yeah. So everyone sitting around who without your hands up, notice who's raised your hands because those are the guys doing deals, at least in the last 30 days. So I'm very happy to introduce Mark, who's bought his first rental. Take it away, Mark.
Thanks, Kurt. Full disclosure, it's all Kurt's fault anyway that this happened. Seriously, I came to Georgia REIA this summer. I invested in real estate a lot many, many years ago. I sat on the sidelines. Last thing I bought was in 2013. Fast forward, went to the buy and hold boot camp in September. That was a very in-depth, for those of you that went, just got us fired up. Monday morning, here comes a thing from Kurt, 2 pages, do this, of which, God knows once in my life, I actually did something and listened to somebody that was an expert at it. Next thing you know, I'm buying or making an offer on a property in Ringgold, Georgia. Part of it is I bought into Kurt's whole idea of having a target customer, in this case, upper blue-collar customers, around good jobs, around interstates, things that just made sense to me. I'm kind of analytical, that made sense. So Kurt just happened one day to send out a, hey, this looks like a decent property to make an offer on. Called the agent, made an offer, got refused, called her back, said, well, how about this? Got that accepted. 2 phone calls. And I think you probably encouraged me to call her back also. And we did an all-cash deal, closed the 13th of October, paid $84,000 for it.
We got some slides here. So Mark went to, there's their before and after, and right here is the, well, you talk.
All right.
Right there's the, there's the before, there's the after on the exterior.
So we went through
The right one looks like it's been photoshopped.
No. It wasn't in bad shape. It had been vacant about 6 months. The owner had foreclosed and got the property back. There was some looked like water damage from the foundation that probably scared people away. Turned out to be nothing. Rehab was basically paint and new appliances. Redid the back deck and put in a little concrete here and there. Painted part of the exterior, the trim. And again, so this was the 13th of October. Had a contractor involved that was recommended by Kurt. This gal knew her stuff and went to work right away. I did some of the work also. Listened to Kurt when he said, well, you need to start marketing your property. So probably the 17th of October, I struggled through and posted ads on Craigslist and every place else that you mentioned, and leads started coming in. Worked with Pam Storm at Rent Marketplace because it's been a few years since I'd screened tenants. Got all that stuff legal and right. And I think on the 27th or so of October, I had it narrowed down to a prospective tenant. When somebody else showed up, that was even better. And they mentioned that they just had cash and wanted to pay me cash as soon as I could approve it. So they rented the property the 28th of October, moved in the 1st of November. We still had a little work to do on the outside. Passed the screening, paid all the deposits. I don't know why people do this, but they offered to pay me November or December rent at the same time, so they didn't have to worry about it during the holidays. So I took a $1,200 rent. This thing capped rate, I think, at 10.1.
Why don't you explain the kitchen and the basic rehab? This is the original cabinets, just painted, new nickel hardware.
Yep. And then the backsplash here was kind of grungy, was a very dated, probably 20-year-old dated look. So contractor had the idea to put beadboard in here, which matched the other walls of the kitchen. So it kind of tied it together. Put a little bit of lighting in. But you can see it looks much brighter. The flooring is a more modern tile or a wood plank look that's vinyl, so it went in cheap. and looks good and works well.
Here's the numbers.
Yep. But for 84, rehab about 16, I got 100 involved, rent's 1,200, cap rate 10.1. Looking for a loan on it now. The DSCR I think worked out at a 75% LTV, works out to about a 1.5 some odd DSCR, so that puts me in good standing with lenders, potential lenders.
Right. The top part here, why don't you go through how you did this and your points there.
Yeah, so I, you know, again, with some of Kurt's coaching, it kind of made it all make sense. I had a plan. I am a buy and hold type of guy. I like the residual income. I wanted to come in regularly. So I had an idea what I was looking for. I defined who my tenants were because it was working real well for Kurt and it made sense to me. And past life, it makes sense. When people have jobs, they can pay rent. So I identified areas, again, that made sense with Zillow. You can just quickly look and see what the schools are rated. I was familiar with the Ringgold area, so I knew how far it was to the Volkswagen plant, the Amazon plant, and the other tier 1 automotive guys that are also built in that area over the last 5 years. And then, you know, like I said, once in my life, I actually sought help and listened. So it kind of made it all work.
Good. Thank you so much, Mark. Georgia not only has this meeting as our main meeting that's networking, and we usually have a speaker, but we have the evening classes. If you just go to garia.com, click calendar, you'll see what's in the evening. We also have a unique resource that no other RIA in Atlanta has, and that's Google Groups. We have the Deal Makers Google Group. It's like an email list. You post a question, or I need a contractor. Who here has gotten contractor referrals off our Deal Makers Google Group? Raise your hand. So I have gotten contractors. Of course, I post contractors too. So that's a fabulous advantage of Georgia RIA's resource. On the new investors list, who has learned something off the new investors Google Group? Absolutely. So these are two useful resources. I'm the guy who gets you on those lists, so guess what? Just contact me or get my business card. I'll get you on these Google Groups if you're a member.
We're doing haves and wants now. Anybody have any haves and wants they want to talk about? Anybody have any offerings they'd like to make? Or anything they're looking for?
We have a drawing, I forgot, during benefits. The Georgia RIA has partnered with Legal Shield because we believe that real estate investors have needs for our real estate problems and reviewing our contracts. And they also fix, or they help you with speeding tickets. But yeah, Carla, so does everyone turn in their blue form that Carla was handing out in the hallway?
We're drawing for a $25 Visa gift certificate.
All right. Well, if you could do the drawing here.
Do you have one?
Not your card, it's a form.
And I wanted to just add too, if you'd like to get a white paper about the Equifax breach, one of the other benefits too is an ID theft. You can text your name to 404-216-0085, and we'll send you a white paper about the Equifax breach and what you can do to protect yourself. Okay, Sylvia Tio. Oh!
Hey, Sylvia, congratulations.
Okay. Well, I will say a few things about Georgia RIA. It's a 30-year-old nonprofit organization. I've had the pleasure of meeting some of the most honest, caring, and straightforward people in this group about investment opportunities. And they give you the real skinny from their perspectives on what to do and what not to do. And I don't think I've met anyone in this group that hasn't had the best intentions when being approached with different scenarios, and that's why I give this group the highest rating for everything they do. They have the top-notch integrity and credentials, and it's my privilege and pleasure to be a part of it. So, what we're talking about today, I'm excited to be here. I'm thrilled to tell you it's everything about mortgages. And I'm going to talk about owner financing. It's going to be a lot of information, but we're going to have fun with it. Mostly, it's to show you what you don't know and what you do know, so you can categorically identify it and pursue it when you need to, just so you can get the big picture. Okay? I know I've introduced everyone before, but again, we have Doug Dean from Schaefer's and Dean, attorney for 25 years. Love to have him up here. We've got Sean Cheristani, broker and Juris Doctorate, works on a lot of credit repair, and then oftentimes puts those borrowers into houses. And then we've got Martin Bakhtiar from Royal Pacific out of California, a $100 million a month volume wholesale lender that sells paper on the secondary market. Thank you guys for coming. So we've been in the mortgage business for 20 years. We hold licenses by Georgia Department of Banking and Finance, NMLS. I'm personally licensed, and we hold standards set by the Banking and Finance and Consumer Financial Protection Bureau. We do offer some free services in consulting, okay? One of them is debt restructuring. If your mortgage interest rates are outside of the average offered prime rate, which today is at 4.125, you should consider looking, well, I'd say 5%. You may want to take a free consultation looking into debt restructuring. We will help you with income qualifying. I know the tax guys talk about where your income needs to be to qualify. We will help you with that and show you where there's room for improvement, if any. Leveraging versus capitalization consulting, it's one of my favorites. We're going to lead into that. Business plan viability analysis from implementation to exit strategy. When you plan on doing a fix and flip or a strip mall or a hotel, whatever it is, we will take a look at the viability of those things. And we'll tell you if it doesn't work. And we probably won't loan you money if it doesn't pass. We'll also tell you about your personal and corporate tax structure. You know, just to spit out a few basics, an S Corp saves you money over a C Corp, generally speaking. You know, you want to avoid 1099s, you want to take K1s, things like that. We'll touch on that. We're not going to delve into it. Credit improvements for clients under contract, we do that for free. My approach is slightly different than someone else's. I throw money at things. You know, if I see a credit report and it's got a collection and a high balance, I'll normally say, pay it down, pay it off. You know, I'm not the guy that sends out letters threatening to sue them if they don't perform, but Sean may be. We'll touch on trusts, self-directed IRAs, and LLC vestings. That's just something that we see a lot of. Don't do it wrong. You know, don't form a irrevocable trust with a defunct LLC as the beneficiary. You know, you're not going to get a loan for a number of reasons. So there's things to tread lightly with and be careful about. And we're going to touch on those. All right, so first consulting brief, we're going to talk about the tale of two brothers, Cecil and Sam. Both currently own 3 properties valued at $100,000 each, and they rent for $1,000 per month gross. Cecil's 3 properties, each worth $100,000, each rent for $1,000. Cecil pays $100 for taxes and insurance, after which he nets $900 on each property. Okay? Cecil listens to conservative advice, follows a debt-free recommendation, and holds constant. He is content with $2,700 per month in income, which equals $32,400 per year. At a glance, this seems like a solid business plan, but you should ask yourself what's Cecil's opportunity cost. Sam also has the same three properties, same scenario. He got advised on leveraging with us. His consultant recommended 20% capitalization and a 1.5 or better debt service coverage ratio. These are kind of true stories, but we protect the names and faces of the innocent. So, debt service coverage ratio is one of the most important factors in our world. You know, you'll hear people talk about cap rates, you won't hear me talk about cap rates. I talk about DSCR. If your payment is, if your PITI payment's $1,000 a month and your rental income is $2,000, that's a 2-to-1 DSCR, debt service coverage ratio, and that's fantastic. What's your minimum requirement for debt service coverage ratio?
1.15.
1.15. I would never recommend you take a project on that's anything less than 1.35 to 1. But he will not deny your loan if you're at least 1.15 to 1. Okay, so with consideration to goals and age, we suggested he leverage with 80%. So, he has 3 properties. He's able to bring out $240,000. Each now have a mortgage payment of $423, 4.875%, 30-year end. He now nets $477 on each property. We did make some assumptions. We didn't have a vacancy rate. We didn't charge for maintenance. But if we had done so, the end result would have been about the same because we would have had to tax both sides with the same amount proportionately. So, the debt service coverage ratio in this scenario is 1.733%. He now collects $477 a month net on 15 properties. His monthly income comes to $7,155 and $85,860 per year. 2 people, same resources, an example on leveraging versus capitalization. So, at a constant rate of appreciation of 3%, in 10 years, Cecil, I'm scared to use the laser printer on this thing. What's that, the yellow button?
Yellow, yep.
See, I knew it wasn't the yellow button. Oh, the yellow button. 10 years, Cecil's worth $404,000 at 3%, the expected rate. And Sam, who owns 15 properties, his assets are worth over $2 million. His mortgages, which would come to about $1.2 million when he started, would be down below $1 million on that amortization schedule. He's worth over $1 million. In a bull scenario, Cecil's worth $500,000, roughly, and Sam would be worth 2.5 minus the approximate $1 million he owns. He's worth $1.5 million. So he's worth 3 times more in a bull scenario. In a bear scenario, with 1% average appreciation, Cecil's worth $331,000, while Sam, his assets are worth $1.657 million. So, still owing less than $1 million, he's worth over $700K. So in summary, Sam's worth more than double Cecil's net worth in almost every scenario. And here it is again. So we charted the expected rate so that we don't get you guys looking at multiple charts. First year, 300, 300. Second year, 10th year, 405, over $1 million. 20th year, 546, over $2.2 million. 30th year, while Cecil's at 737, Sam's at 3.7 million. Sam also earns $7,155 a month, while Cecil's earning $2,700. So this is also not even taking into consideration what Sam would make if he reinvested the difference in income if he reinvested the income, over 30 years would be an additional $3 million, and 1.6 after the 20th year, and 656 after the 10th year. So Sam would be a millionaire by participating in concepts that involve leveraging his assets and not capitalizing everything, while Cecil, doing well by most people's standards, would definitely be left behind in the dust. I'm going to open it up for discussions, and you guys are welcome to ask any questions for me or the contributors.
Rick, under what scenario could a lender ever call one of those loans that was being paid due? If their property values took a dive or something? I know that, I heard stories, at least I wasn't there at the time, but of people losing properties when they were current on loans.
Yeah, that happened a lot with HELOCs, especially in 2008 and 2009, especially after banks were being forced to meet liquid requirements. I haven't heard of, technically the only thing that I'm familiar of, which maybe Doug can contribute to, is the due on sale clause. If you violate that, but I still am not familiar with any scenario where a violation of the due on sale clause on a current mortgage has ever been called due.
Typically, your note will tell you if it has a demand clause, and a demand clause means that the lender can demand repayment in full. The most common one is the due on sale clause that says if you transfer your legal interest in the property, the lender has the right to call the note due and payable and demand repayment in full. But that's typically, with most traditional mortgage, the only demand option. Rick correctly spoke about some of the financial holes that people got into. One was if they had some type of balloon payment and the property value had decreased and they were unable to refinance and step out of the hole. I had a friend who had bought some farmland, beautiful property, and they had put it on a 35-month balloon. And this was the time when property values fell, and they'd made every payment for 35 months. And they asked the lender to refinance, and the lender wouldn't refinance because the property value had gone down. So they had to scramble and pull assets out of other areas just to pay down enough on the property to refinance it. So even though they had been current, they got hit with a balloon payment and were unable to refinance due to declining property values. But generally speaking, and you should know up front, under what situations does my lender have a demand clause other than the due on sale clause? And typically with a traditional mortgage, there just shouldn't be that type of occasion. Rick also correctly noted that for a lot of things like equity lines, home equity line of credit, they do have the right to curtail your ability to borrow against the property if they feel under-collateralized or under-secured. For example, if you lose your job, they might say, I don't want to extend further credit on this property. Or if they feel the value of the property has declined, the line of credits typically give them an option to cut off the flow of credit in certain situations, but that's not so with a traditional mortgage. As long as you make the payments, you remain in good standing.
Martin, have you guys ever called a...
No, we're more the traditional mortgage. We don't do the lines of credit. So, like the gentleman was saying, unless you miss a payment,
unless you miss a payment, we're not calling the note due. It's a traditional mortgage. So there's really, and the only other choice is if you sell the property, then we're going to, we want to be paid. But as long as you pay on time, we're not going to even. We're never going to probably call you except to say thank you.
I've never seen an instance of a mortgage called due. And a lot of conventional loans are transferred into LLCs. And if you were ever concerned with that, that would be a good reason to use a trust. But if you do use a trust, I encourage you to use a revocable trust. Because irrevocable trusts, although they have their benefits, such as, someone can't sue you and then go after the trust, it has a separate tax ID number, it has tax advantages, things like that. You don't own it anymore. It's not yours. A revocable trust is truly still yours, and it's designed for that purpose, and you can protect your interests by putting anything in a trust, and it's been done for a long time. But I don't see any problem at all with transferring a title from yourself to an LLC after closing or into a trust. And I've talked to hundreds of underwriters and seen it done in 1,000 instances. I've been in the industry 20 years. In the first decade, I probably had 70 loan officers that worked for my company. So I have actually had thousands of files, and we've had multiple instances of title transfers, and not one situation was a problem with that alone.
And you're referring to traditional mortgages,
I'm
conventional mortgages.
I'm referring to conventional mortgages, which are the most conservative. So non-agency mortgages, a lot of times they want you to put the title, the vesting in an LLC. And so that would be even looser. So conventional mortgages would be more conservative than a non-agency mortgage. And Royal Pacific does both conventional and non-agency.
We also do
We don't care if you close an LLC, you can actually close in the LLC. We don't generally want more than 3 members in that LLC when you close, but like Rick mentioned, if you want to close and then transfer it in there, that's fine too, but a lot of our customers close in the LLC or refinance. And we can touch on the DSCR too. We do that as well. We will do it pretty much, we're just looking at the lease. We're not looking at your income. We'll go up to 80% on a purchase to $1 million, and we will go 70% cash out. If it's a free and clear property, so another way, if you're trying to get money out of a property, if it's free and clear, we'll loan up to 65% of the value. We don't do any really of the fix and flip. More of our products are more permanent. So it's when you're coming out, like the gentleman that did his property up here, that would be what we would do. We're looking more for the long-term loan, more traditional. Everything we do is residential, even though the DSCR is a commercial type product, it's still a residential loan to us. And, but it's we have a lot of different products. We do every loan that you could think of, with the exception of home construction and the 203K. Anything else we do. And anything that you need to pull cash out of, we will do. We do bank statement loans to 90% to $1 million. And so it just depends on what you're doing. But yeah, the DSCR is an awesome product. Thank you.
Thanks. And I'm going to touch on a couple of things. I know it's on the back of some people's minds. Where are we now compared to where were we 10 years ago? We're nowhere near where we were 10 years ago. 10 years ago was the Wild West of the mortgage financing industry. Appraisals, which are the collateral, which is the single most important thing, are so regulated now. So 10 years ago, when you were doing a 90% loan-to-value loan on an appraisal that could be directed to whatever, was worth a lot. You know, you're doing a much higher than 90% loan-to-value loan. You're doing a 125 in a lot of instances and calling it a 90% loan-to-value loan. So that is the singular most conservative element that's happened this decade to the last. The appraisals now go through an appraisal management company. Loan officers aren't allowed to talk to them. When we have deals die in appraisals, they're just dead. That's it. It's end of story. And that's how it should be. And I'm glad to see it happen that way, because those deals should not go through. Another thing that happened 10 years ago that didn't happen, that's not happening now, is 100% financing on stated income loans. You know, those don't exist. The Dodd-Frank Act regulated those more than anything else. And again, those were more like 125s on loans that should not have been done to begin with. So the Consumer Financial Protection Bureau identified some problems. Sure, it was a secondary market. Sure, it might have been overzealous salespeople. But it also is the average consumer was more ready to take a risk than should have been. And that's why the CFPB established the Know Before You Owe policy and standards, which they made it our jobs to educate borrowers. And I would have never believed it if you told me we were going to have to educate every borrower. But we pretty much have to educate every borrower. Now, back to mortgages. What does it take to qualify for a prime mortgage loan? There's 3 fundamentals, okay? A prime loan, so the Dodd-Frank Act established the Consumer Financial Protection Bureau. The Consumer Financial Protection Bureau created 3 buckets. The first bucket is prime. Prime is defined as the average offered prime rate plus no more than 2%. So if the average offered prime rate is 4, no more than 2% is 6. So anything from 1% to 6% is in the prime bucket. Now, those agencies are Fannie Mae, Freddie Mac, FHA, VA, USDA. Those are the agencies. So when you talk about a non-agency loan, that means it's not being sold to the agency. It's being sold to a hedge fund. It's being sold to a private investor group. It's being sold somewhere other than an agency. Now, for agency loans, there's strictly 3 criteria. Income, and then the debt-to-income ratio there to follow. Credit criteria, and assets. Someone calls me to make an application. I have 3 questions. What's your income? What's your credit? How much do you have in assets? Those are it. From those 3 pieces, I can tell you what you qualify for. We are good at working with the self-employed. And the reason we're good at working with the self-employed is because we took the time to learn the underwriting guidelines and criteria. We know what's an intangible expense and what you can add back. So, we know how to dismiss obligations to the business on the basis of Fannie Mae's continuity of liability premise. Sounds complicated, it's not. If you have an LLC and the LLC pays a mortgage on the investment property, that's a continuity of liability. The LLC pays the mortgage, it's dismissed from your personal DTI. That is one premise of qualifying a borrower. Diminishing assets or setting up annuities to increase income for higher asset clients. If you have $500,000.
On that question up there, if you have a house and a mortgage that's in your name, but you're running it through an LLC,
yes,
that mortgage is still in your name, so is that something that can be dismissed?
Yes. If you can show 12 months canceled checks or bank statements that the company pays it, and you're not doing improper tax preparation where you're deducting the interest from yourself personally. So your taxes and your company documents have to both support that statement, and then by all means, yes.
So an S corporation that flows through wouldn't work.
Well, if your S corp has its own bank statements and your S corp pays, no, an S corp would absolutely work. Okay. Your corporation pays the bill directly. So what flows through is the profits, but the liability, it's a separate entity, it's a corporation.
Sir?
Yes?
What you just said about the LLC, a single member LLC is transparent as far as the IRS is concerned, so my single member LLCs show up on my Schedule E. As if I made the payment, even though my LLC has made the payment.
Right. You would have
Are you saying I'm breaking the law that way?
No, I'm not. I'm saying you may want to file an 1120S instead and have a separate return for your LLC. If your LLC can have a separate return and a separate bank account, and show a separate entity, then it wouldn't count against you personally.
But I have like 20 properties, so I would be filing 20 additional tax returns?
Not necessarily, not if you have the LLC pay for all 20 properties and you're trying to dismiss all the...
Each property has its own LLC.
Then yes, it would be, if you want to dismiss each one categorically. Did you want to say something, Doug?
The only thing I was going to mention, you mentioned with the single member LLC, you still have the option to file the IRS form to elect to not be a disregarded entity. When I first started many years ago, my first solo law firm, and I was the single member LLC, I still elected to be taxed as an S corporation versus putting it on my own personal Schedule E. So you do have that option. Likewise, if there are two members of the LLC, the default IRS rule is that you're going to be treated as a partnership unless you elect to be taxed as an S corporation.
So to answer your question, yes, you could do it. The logistics of it, you'll have to work out. Diminishing assets is one of my favorites. So if you have $300,000 in an IRA and you want a 30-year loan, we've got to divide that $300,000 by 360 months, and we can add that to your income as additional income. Or you can set up an annuity, and as long as that annuity is continuous for 3 years, we can count that income. Any questions on that point? We can add back depreciation, depletion, mileage, non-reoccurring, and intangible expenses to income. I've added back Las Vegas real estate courses of $100,000 on people's tax returns before. So there are people that spend the money on it. She made a ton of money and made a ton of contacts, so I can't knock her. She'd throw a purse at me if I did, but we were able to add it back. She had a big red number, and we were able to turn it into a solid number that qualified her. The omission of carry forward losses from income calculations. If you have a carry forward loss, like a lot of people do in 2008, we can omit that. Actually, that's one of the examples we have. Adding additional income sources, partners and borrowers, that's an option. You can always add additional income sources.
Okay.
Yes?
I think you skipped one bullet there. What was that second to last one about 1 year's tax return?
Use of 1 year's tax return for Freddie Mac. I don't know how I could have skipped that. We do a lot of loans for people with 1 year's tax returns. For conventional loans. For example, your whole life could have been showing $1,000 in AGI. And then in 2017, you show six-figure income, enough to qualify you debt-to-income ratio-wise. Freddie Mac will do your loan. It's conventional. There's two, it's agency. Fannie and Freddie are conventional. There's really no difference other than Freddie Mac will allow you to use 1 year's tax returns. Freddie Mac favors the self-employed, prefers higher assets. When we run automated underwriting systems, a lot of times things that don't take Fannie Mae take Freddie Mac. Do you have any comments on Freddie Mac? I love Freddie Mac. Go ahead.
What Rick is saying, they're different underwriting. One's DU is Fannie Mae and LP is for Freddie Mac. But one of the ones I like for Freddie Mac is the way they do student loans. Fannie Mae, they're strict about how they calculate your student loans, which may not apply to everybody, but on Freddie Mac, if whatever the number is that's reported on your credit bureau, even if it's ridiculously low, the way the guidelines are with Freddie Mac is they will take that payment as your payment for student loans. So that's a huge benefit. The other thing is if you have a down payment from a nonprofit that is going to give you down payment assistance, and if you will be let off the hook if you live in the property 5 or 7 years, Under Freddie Mac, that is considered a gift and doesn't affect your LTV at all. So that's another big difference. Yeah.
Well, thank you.
So it's a difference in everybody.
I learn stuff every week in this industry. And it's constantly changing. Here's an example of a return. So here's a carry forward loss, negative $2 million. Income $492,000. AGI negative $1.6 million. His income qualifies, no problem. No problem, does that income qualify? We may need a CPA letter that asks what year was that carry forward loss, just making sure it wasn't last year. That's one of many ways to be aggressive with taxes, but still qualify for conventional financing. Income document types. Well, we've got W-2 employees, we've got sole proprietors who typically file Schedule Cs, we've got individuals with business returns, maybe an 1120S, normally take K1s, multi-property owners normally file Schedule Es. We're open for discussion.
I have a quick question. In the last Georgia Real meeting, you had mentioned that that mortgage-backed securities are no longer being bundled and traded. So I was wanting to ask you, how are these mortgages being converted into cash in the secondary market now if they're not being sold on Wall Street in mortgage-backed securities?
Do you want to talk about secondary market sales?
It's the same. I mean, you know. You answer that.
Well, there's a lot of hedge funds. There's a lot of private money groups. They are being bundled and sold, but it's not in the same fashion. It's not in the same format. All the agency loans most of them are sold to Fannie Mae, Freddie Mac, and a lot of them are just the not agency paper is being held with mostly private investors. Yes?
Seems to me back 10 years ago, one of the biggest problems we had was the people that were evaluating the mortgages were lying.
Yeah.
They were calling them AAA, and when they were really B or C or D portfolios. Has that changed?
Yeah, that was Moody's, and they're not really being evaluated the same way at all. So let's say that one of you guys are a investor in notes. You're going to want the same criteria that's happening now. You're going to want strict appraisals. You're going to want skin in the game. You're going to want real borrowers. I'm going to get to some of these criteria, and I think you'll find that everyone's putting down hard equity, 10% out of pocket. The only real agency that's not requiring a lot of skin in the game is FHA and VA. And a lot of people are supporting VA, support your veterans, 100% down. That's not going anywhere, and it's almost a patriotic product. FHA is killing it. They made so much money with their insurance premiums. They wanted to reduce the premiums, and it was defeated. They said, no, keep it in the coffers. So now you're talking about, go ahead.
FHA is pretty much the new subprime. They do 96.5. Even us, we'll get under a 550 credit score on a manual underwrite. So that's really, that subprime market's gone away, but FHA picked up a lot of the slack. And other than that, the other products do require at least a percentage down and 10% across the board. There's none of the stated loans that you saw before for owner-occupied. In fact, Frank Dodd did away with that. So if you have an owner-occupied property, it's got to be full doc. They will allow bank statement programs, which they consider to be full docs. It's a cash flow loan. So that's about as loose as you get. And the appraisal's been tightened up and getting back to securitizing debt. These people are looking at this debt because they are putting their name on it. And what happened, I think everybody was guilty. I mean, everybody back in the day when the non-prime, subprime business went down. But what people don't realize is subprime only made up less than 10% of all the mortgages that failed. They just got the bad publicity for it. There was a lot of other loans out there. One of them was the payment option ARM. I don't know if you guys are familiar with that. That was one of the biggest products out there, and people were running negative AM loans each month. It's the only way anybody could afford anything at the time. It was over several $1 million. And out in California, they were making these loans hand over fist. And they were paying out big payouts. And what would happen? Never got in the news, ever got in the news. There were more of those loans than there were the subprime. And what happened was each month you get a card statement like you do for your bank, for your credit card. You'd have three options. You could pay the amortized payment, you pay a minimum payment, or you could pay the interest-only payment. Now, which one do you think people took? They took the minimum payment, and that was a negative AM payment. So each month they were adding more and more to the back end of their loan, and then the fake number of the property value crashed and burned, and that's what really got everything spinning out of control. And what Rick touched on with the appraisals, the way it used to be back pre-2008, is that when you got a loan, you could call up the appraiser and you would say, hey, this is Rick. I need this property to appraise for $300,000 and to get a loan. And what was really popular back then was the 2-year note, the 2-year ARM. And appreciation in Atlanta, I was back in the market back then too. Appreciation was running close to 10% a year, which is unrealistic, but it was. Kind of like the stock market. And so what happened was somebody figured out that it had maxed out, and the actual the tip of the iceberg was in 2006. Somebody went back and charted it. When the property values had maxed out was 2006, but it took 2 years after that before the house of cards fell. But it used to be that you could just ask the appraiser. You didn't tell him. A lot of people did, but you just call them up and get what can you get for this property? Can you get $300K? And they go, yeah, I think I can make that work. And so they would just pick the comps that would make it work, even if the value that wasn't the real value. Nobody looked at these appraisals. Everybody was, if anybody was guilty, it was everybody. Anybody that was involved with the loan, the lender, the borrower, the real estate, all of it. So
let me give you an example.
Yeah.
Let me give you an example to shed a little light on his example. So let's say you had a $100,000 house 10 years ago that you could have appraised for $125,000 that was stated income. You're having a borrower that can borrow $125,000 on a $100,000 house with no income. Now that loan is impossible for owner-occupied. If that borrower was full documentation income, which is all that you can do now since the Dodd-Frank Act for owner-occupied, that same borrower would be able to borrow $90,000 as opposed to $125,000 on the same 125 house. Not to mention, there's a lot more severity for buybacks, frauds, and performance criteria on the secondary market enforced by the lenders to the brokers, and I'm sure from your investors to the lenders, because we have performance criteria that we have to subscribe to also. Especially first payment default and non-performing loans would definitely get us in more of a pickle than almost anything else we could do.
Just to add on what Rick and Martin were saying on the what caused the crash, I was in the trenches during the crash, doing a lot of short sales. So one thing that I observed was that in addition to all the stuff they mentioned, one of the biggest players and probably causing the crash were the builders. So the builders were essentially pushing their properties to the public, many of whom weren't even represented by their own agents or brokers, which is why it's important for everybody in this room to have their own agent or broker to protect your interests and rights, because the builder's agents don't have that responsibility to protect your rights. They're not representing you. You're just a customer to them. So what they were doing, the builders were getting the appraisers to appraise their inventory at higher values, sometimes even inflated at 1.5 times what they should have been worth or more, and created all these issues along with the appraisers. And the lenders were just going along and shelling out the loans. Because a lot of times the builders have lending partners, if you notice, if you ever go to a new subdivision. So it was all a concerted effort that caused all this. I'll give you one example. I did a short sale for a couple, and this speaks to my ability and skills on getting stuff done like this. Both of them work at Verizon. One of them was an executive over there, and the other one is managed an IT team over there. At the time, they both each made over $150,000 a year, plus their bonuses and whatever, extra money they were being given with the perks and the free gym memberships and all that. So, and that was a lot of money back then for a household to be bringing about $300,000+. So they owned a house that was worth about $500,000 in South Forsyth. And they had bought one of these condos in Atlantic Station directly through the builder, which was a huge mistake. The builder sold them a 1-bedroom condo for approximately $340,000, facing the south side of the building, which was eventually blocked by the same builder putting up an even bigger building. So they lost their view, which was partially the reason for their valuation, because the ones on the other side were cheaper, facing Buckhead. So what happened, these guys shouldn't even qualify for a short sale. But leveraging, and this is important, I'm going to mention leveraging, Rick mentioned earlier also, when it comes to managing your credit and creditors and all that, leveraging all these facts that I was aware of, we were able to force SunTrust to approve the short sale. Ultimately, the property sold for $78,000 cash to an investor who was buying it for his son who was going to Georgia Tech. He was a cardiologist what's that town over there in South Georgia? I forget the name of the town, but anyway, so he ended up buying it cash. So essentially, if you calculated, the property lost like over 80% of its value based on what they paid. So, which is unusually high in Georgia. Now that happened left and right in Florida all the time, but this was probably the higher end in Georgia. So, all right.
Thank you for that, Sean. Okay, Steve?
Hey, Rick, before we leave, looks like we're leaving prime. What kind of debt to income ratio? When I went to CFP school, it was added. It was 28 on houses, 36 total. I hear numbers like 43, 46.
I've had FHA deals approved as high as 55. I've had most of your Fannie Freddie stuff will get approved between 45 to 50. Most, if you have low assets, you're looking at 44. I've 44.9 most of the time. If you have moderate assets, you see 47 most of the time with Fannie Freddie. VA and FHA are usually in the low 50s. What's your experience?
It just depends. Real quickly, when you run it through a DU or LP, it's called risk. It's layers of risk is what the software does. So it's looking at credit score. It's looking at all the credit lines. It actually reads the pay history. It's looking at your assets. So it's going to go. It's going to filter through that. And if you have to get to a manual underwrite, so to back up real quick, if it runs through there and it likes it, it's going to give you the approval even with a high DTI because you have great credit, good, depth of credit, you've got a good credit score, and you have assets. And length of time on the job, it looks at everything. But if you go to a manual underwrite, the underwriter's hands are tied to whatever the guidelines are. FHA is real strict, and the lower the credit score, the lower the DTI can be. And you can get a compensating factor like I have money in the bank. Then they're going to let you have the DTI higher. But typically on a 550 credit score, you're at, what is it, like 40% on the back?
I want to say 43.
Yeah, 43, 36, 37, and 43. Yeah, their front can't be over 37.
How many manuals do you actually do?
We do a few, because we will go a 550. I don't encourage it, and because there's a reason you're a 550 in the first place. So, yeah. I mean, my customer says, okay, I've got a 550, so I've got a loan. It's like, no, you got a chance. But because then when you start looking at it, there's a reason that you're a 550.
Probably 0 times 30, no collection in the last 12
Lots
months.
of money, yes. It's a fluke that you got a 550 credit
Yeah,
score.
exactly. It's almost got to be a fluke.
So Rick, one of the, you guys keep talking about assets. You mean net worth or assets?
Cash in the bank.
Assets are liquidable assets, which means stocks, bonds.
Not net worth, not net worth. It's
Right.
cash on hand, it's liquid cash.
Yeah.
Either cash in the bank or a 401k. If you're not 59 and a half, they'll count 60% of that.
60%.
Yeah. Equity on investment properties is not considered an asset.
Yeah. Liquid.
Right. Well,
I was going to add something on the point that he was making, that it's not a good idea to go and apply for these loans with a 550 score. That's where people with knowledge of credit and resolving issues and all that come in handy. I offer that to clients. It's not part of my real estate brokerage business, but I'm also a mediator, so I do a mediation style type of credit consultation for clients. One of the things I recommend is, if most of the time people don't know their rights when it comes to items on their credit report, they don't know how quickly they can resolve those issues and how fast they can get their scores up. It is a lot quicker than most people in this room probably think. It could be, we've done it in as little as like a week to a month, at the back end of it, at the longest time frame, maybe 2 months if you have to reestablish credit. But it's doable, and you can get that score up by, I would say, at least 70 to 150 points, once you get the issues resolved. So
yeah. On that note, that credit repair class that we're doing, we're actually going to be repairing everyone's credit or improving everyone's credit during that class. You actually get a credit report, and we're actually going to, most of the time you pay down balances, but you'll get to see specifically what happens with each transaction through the score simulator, and it's included in the course, which is a $39 charge for the credit and the simulators, and then $200 is actually the charge for the course. So it's $239. I believe it's December 16th, isn't it? It's December 16th from like 10 to 4. So if you're in the mid fives and you can do something relatively easy, we will tell you exactly what to do. If things need to get contested, then it is to engage someone who can send dispute letters and things like that, and Sean is great at that.
Yeah, I'd like to get your opinion and Mark's opinion on, I think your name is Mark in the mortgage business.
Martin.
Martin, okay.
That's
I'd
all
like
right,
to get
close
your guys'
enough.
opinion on this question, and I think this will probably benefit everyone here in the audience as investors. And I'm thinking many of us here in the room may not have saw the last recession coming. Historically in the U.S., recessions happen every 7 to 8 years. Right now, we're literally right at the 7th year. The recession, ended literally in 09, 010. So being 2017, in its 7th year, what should investors be looking for in terms of, when the next downturn will start and will happen? What are the KPIs that we should be looking for in terms of, hey, this thing is turning down now?
Okay, 10 years ago, we saw a lot of people financing more than 100% of what their properties were worth with no skin in the game. You saw a lot of cash out purchases. You saw people taking the money and running. You saw a lot of first payment defaults. That was not an overnight process. That happened over 2 years. And we should have seen the writing on the wall, because it happened to California first. And he's not kidding when he's talking about those pay option arms and the 2-year fixed products that were at LIBOR +6 on adjustables. When they adjusted after 3 years, they went crazy. A lot of people couldn't afford those products. They were based on stated income things. We are not there. Now, when is the next, what's going to happen in the market? I can only speculate, but I will say this, there is no such thing as a cycle. We have never been in this point in the history of the world before. You can't apply a pattern because it's not necessarily written on the walls. I don't believe in the cycle. I don't participate in it. I expect a slowdown in growth, but still a growth. We've had too much of a growth spurt in the last year. It's impossible to maintain 4.5% appreciation. I think the property values in Atlanta are realistic and they're going to stay solid. I don't see any symptoms of a correction in the residential market for years to come. The multifamily housing is slightly overbuilt. I expect a slight correction on that. I don't think the commercial space is going to sustain. Too many people are going virtual with office space and things like that. I expect to see some downzoning and a lot of commercial space to go residential. But I expect us to have a solid run for 5 years and expect slower growth, but I see good things happening, especially in Atlanta.
To add to Rick's point, I think each part of the country was affected differently with the last great recession that we had. And in my opinion, and I've got over 20 years of experience in real estate and law, and I could say that Metro Atlanta area is drawing a lot of relocation currently, and the builders are building still, and it's going strong. The homes are going under contract. So the draw that Metro Atlanta has, I think, is going to balance out any kind of downturn or slight correction we might face in the near future. So that's definitely going to help, especially compared to some of the markets around Metro Atlanta and other states like South Carolina, Mississippi, and even Texas and Alabama, where the economies are not as strong as Georgia. So as long as there's demand and the economy is strong and the supply is under control, which I think builders have been keeping it under control, I don't think we're going to see a fiasco like the Great Recession anytime soon. In my opinion, I think the next correction we're going to see is going to be a mere plateau. I don't think it's going to be a huge downturn like we saw before, like a drop down in the curve of the nosedive. Yeah. So,
very few people are going to put 10% down payment, 5% down payment, and then dump their properties. That's not going to happen on the scale it did a decade ago. I'm going to move on. We're going to talk about owner financing. I know it's a topic a lot of you guys came here for. We're going to cover some. Regs. So, what got us here? Well, the SAFE Act was done in 2010, required individual licensing for loan officers doing owner financing property. The COA has been around, but it's been added to it and some changes have been made, and we'll talk about that in a moment. Reg Z, Truth in Lending, that's been around, hasn't changed much. GAFLA, the Georgia Fair Lending Act, the first change to GAFLA happened around 2005, limiting points in Georgia to 5%. Dodd-Frank then limited it to 3%, but established the 3 buckets, which is prime loans, defined as the average offered prime rate, which is approximately 4% on conventional loans, plus 2. Higher cost loans, which is 6% to 10% in that same scenario. It's defined as the average offered prime rate plus 2, no more than 6. And then anything above that is high cost. So I know they're not creative names, the legislators made them up, but those are what they're called. There's prime, higher cost, and high cost. Now, we've gotten creative with that, and prime is also known as agency. There's a few preferred non-agency lenders that are in that box. And then We've dubbed the name soft money to the second box, which is basically 6 to 10%. And we've dubbed the name hard money to the third box. Rumor has it that the Financial Choice Act of 2017 is going to dismantle Dodd-Frank. Dodd-Frank has a lot of stabilizing regs built into it, such as the evaluation of mortgage-backed securities and anti-money laundering schemes, and a number of regulations that stabilize the economy. There are things that deregulate small businesses in the Financial Choice Act, but mainly it adds stricter regulations on fraud. And that dismantling is more of a rumor than anything else. So the SAFE Act is a secure and financial enforcement mortgage licensing. Only employed NMLS licensed MLOs by licensed entities may collect application information. Now, an application is not a 1003 form. An application is defined as 6 pieces of information: name, income, social, property, address, estimated market value, and loan amount sought. You could be a genius, take applications mentally, and that would be an application. Penalties for taking applications include criminal charges and penalties up to $25,000 per incident. ECOA, Equal Credit Opportunity Act, makes it legal to discriminate based on protected classes. Sure, that's simple, everyone understands that. It adds appraisal requirements as a basis for discriminating in lending. So if you don't give someone an appraisal and they say that you charge them too much for the house, and then trend analysis figures a demographic associated to that, it could possibly be a violation to ECOA. Also, it requires ethnic and race reporting data by lenders to HUD. Penalties for violating ECOA allow up to $10,000 per incident. We're currently in the mortgage industry, the Mortgage Bankers Association are fighting trend analysis. For example, if you build $300,000 houses and have built $300,000 houses your whole life, then you go into 30310 and build $300,000 houses, you're arguably participating in the gentrification of 30310, and then you could possibly be discriminating against a class. So that is the trend analysis piece that makes it so argumentative. Truth in lending, Reg Z requires disclosure of APR and closing costs, penalties for that. So truth in lending requires the disclosure of APR. Criminal charges allow for, you guys actually have this on the handout. It's on the back of the, this page. Okay. So, we've discussed truth in lending. Reg Z requires disclosure of APR and closing costs in a standard format and respite time frames. The next one on the list, GAFLA, Georgia Fair Lending. Limits lender points to 5% collectively and allows for lender licensing exemption in a limited capacity for a natural person to owner finance up to 4 properties per year without a lender license for owner-occupied properties. Penalties for criminal charges. Penalties include criminal charges, imprisonments up to 6 months, allows for civil punitive damages up to $1,000 per incident. Okay, so this is where your lender exemption comes in when you do owner financing. It's up to 4 properties. I think the actual code says no more than less than 5. But that sounds like 4 to me, and allows for it for a natural person. Dodd-Frank requires ability to repay, sets income and asset fee limitations. on qualified mortgages. High cost became outlawed on residential, and it established the CFPB empowerment and the know before you owe attitude to financing. Penalties include civil and punitive damages up to $5,000 per incident, $25,000 on second event, and $1,000 for the third. Okay? All right. So now that we've bored you guys to death, let's have fun and have a scenario here. All right, Cecil's back. Cecil verifies Joe's ID, Social Security card, and gets a paycheck stub to check his income. Cecil does not collect a rental application, nor check his background or credit. After renting for 2 years with on-time pay history, Joe wants to buy the house. They agree on a purchase price of $100K. Cecil takes $1,000 in earnest money towards the price, and Cecil agrees to owner finance the rest at $99,000 with a contract for deed. Cecil's attorney writes it up. Cecil's LLC is the grantor, and Joe's the grantee. Is this owner financing? Is the first question. Yes? Yes. Okay. So yes, it is owner financing. And what regulations would you say that Cecil violated, if any, in this scenario?
Darts.
Huh?
You gonna throw darts?
Okay, let's go back. Oops.
Oh.
So the first question is, did Cecil take an application?
No.
Yes. Cecil
No.
took an application. So that violates the SAFE Act. Next question. Did Cecil violate COA?
What was that again?
COA, Equal Credit Opportunity Act.
Well, you said something about an appraisal requirement, but it was not.
It's arguable whether or not he violated a COA, but probably, since he didn't produce an appraisal or a third party. No, it's a contract for deed.
Purchase. Initially, it was lease purchase.
No, it was a lease.
It's a little vague.
Yes.
Discuss a future purchase of front. It's a
Uh,
little ambiguous.
So, arguably, he did or didn't violate a COA. I would say since there was no appraisal opinion produced, I would lean towards the side of violating a COA. Okay? Now, you guys don't have to take my word for it. We do have an attorney here, but I'm going to present and then you can ask him what he thinks. Now, the third piece, Reg Z, TILA, disclosure of APR. I think that's clear that investor would be in violation of TILA in this scenario. And then Georgia Fair Lending Act, technically he's in violation of Georgia Fair Lending Act because it wasn't done it in his own name as a natural person. But that penalty would be tougher to come by. And then the fourth, the Dodd-Frank Act, since it didn't come across as qualifying income and assets, then, or educating the borrower, understanding know before you owe, it would be in violation of the Dodd-Frank Act.
ATR.
Ability to repay.
Yes. It doesn't say that he did, so we're just for this example purpose saying that he didn't do much. Did it in passing. And the less he does in this particular case, the less his liability would be. So, in this case, he probably violated all the laws, arguably a COA, and probably a few others.
And Rick, I don't know if this is when you want to deflect to an attorney, but the example you described started out as a straight up rental, right? And then along the way, he converted it to a contract for deed,
That's correct.
which is not going to transfer the title until someday in the future, if and when he actually makes all those payments. And if he doesn't, it's a simple eviction, no different than a rental.
Mm-hmm.
So does a contract for deed actually get to the bar of owner financing and all these regulations?
Yeah, it was actually established in '82, Shivless versus Realty Group. It established that a contract for deed was owner financing because, yeah, because it created a grantee-grantor relationship. Yeah. Any bond for deed or grantee-grantor relationship is, in fact, owner financing. So, from a common sense standpoint, the CFPB wants you to educate your consumer on closing costs and qualify his ability to repay and be fair and impartial and disclose APR, closing costs, and do it within 3 days of taking the application, which you can't legally take, and issue an LE, and then 3 days prior to closing, send a CD, which you also can't legally prepare since you're not a licensed loan officer.
So for Cecil to have done that and not violated all these, he could have hired you to run the application process?
Yeah.
So say the deal does go through, the buyer's happy and Cecil's happy, who would actually go after them?
No one. It's a victimless crime in that case, and well, maybe I'm going to get. Feel free to Google any of this and correct me if a correction is in order. Thank you.
The only comment I was going to make about that is it's not a problem until it becomes a problem. Every borrower is going to repay until they don't. And once they do, they look for outs. And failure to comply with regulatory requirements is a good out. One of the regulatory, is it TILA or Dodd-Frank, requires that the lender actually repay the money to the borrower.
That's Dodd-Frank if it's high cost. If it's over, if it's high cost, which is defined as the average after prime rate plus more than 6, which is 10 today, that means that they could request you to pay back all the payments.
But the short answer is, it's not a problem until it's a problem.
And another thing is the punitives on it are collectively $46,000 in that case also.
I wanted to add something to this part about regulations and following them and borrowers looking for outs. This is precisely the same type of strategy that I use to help clients with credit issues. So even if you had a catastrophe in the past, you owed some money to somebody, you defaulted on it, wanted to charge off, you still have rights. In fact, Equal Credit Opportunity Act is a lot more expansive than just this portion that they're mentioning. It covers a whole variety of credit discrimination, including with credit that's credit cards, revolving, installment, everything. So just because you guys defaulted on something in the past, don't assume that the lender or the creditor is not in violation of some of these rules. They could very easily be in violation of them, such as the Fair Credit Reporting Act, Equal Credit Opportunity Act, Fair Debt Collection Practices Act, and many of you probably haven't heard of the Fair and Accurate Credit Transactions Act, which adds a lot more specificity to what constitutes a violation and adds additional categories to it.
That doesn't apply if you're not reporting them.
Huh?
That doesn't apply for someone who's not.
Yeah, if it's reporting on a credit report, you can leverage all these regulations and all that essentially, because you're entitled to statutory damages under all these statutes if somebody's violating your rights. Statutory damages are essentially what the statute calls for. If there's no other damages, you're also entitled to actual damages, but those range between $1,000 to $2,000 per violation on most of these federal credit acts. And there's also state counterparts. And also keep in mind that sometimes, and I see this regularly, creditors are not just in violation of federal credit reporting acts and Fair Debt Collection Practices Act, but they're also in violation of state counterpart acts, as well as sometimes in violation of fraud acts and even criminal laws. One of the fraud ones that I help clients use regularly is the Unfair and Deceptive Business Practices Act. You know, several times, for instance, I've seen collections on clients' credit reports when they leave a telecommunication company, and all of a sudden, let's say their monthly bill was $100, and they told them that, you know, they paid the last installment and everything's good, they can go to a different company. Especially when there's service problems, you have rights under like the FTC with respect to how good your service is. If they breach the contract, you don't have to pay that early termination fee. But I've seen collection amounts as high as $5,000 under T-Mobile, under like, AT&T and some of these other companies on credit reports. This is outrageous in my opinion. This is clearly unfair and deceptive business practices, and the clients are entitled to damages. And you can leverage these acts to essentially get them to back down, delete those items, and clean up everything. So if you have even minor issues on there, this is the way to go. So, but that's just the gist of it.
All right, so, yes.
You're basically saying all of those regulations, a private individual can't sell their own home without following all of these guidelines. Can't do that.
Sure, yes, I am, and let me tell you why. Because when you become a lender, when you act as if you're a lender, you're operating under the exemption statutes of a lender. So the regs allow you to be a lender, but it doesn't exempt you from all the regulations that lenders have. So you can be a lender if you choose, but you still have to subscribe to all the rules and regulations that lenders have, such as lenders have to hire a licensed loan officer to take applications. Lenders have to disclose closing costs and APR. Lenders are not allowed to discriminate and must provide a copy of the appraisal within 3 days. Lenders are not allowed to charge more than 3 points or interest rates that fall into higher costs if the borrower qualifies for prime rate loans. So I'm here to just explain that the wave of lawsuits, if they come, when they come, if they come, happen in bulk. And we much rather loan millions of dollars than spend time educating everyone's borrowers and putting you guys into compliance, because we don't even like doing it for ourselves. But I want to just at least communicate these points so you don't have exposure, because I see it all the time and I'm aware of it.
Well, Rick, wouldn't you agree that the solution to Dodd-Frank and an owner selling their own home and with financing is to hire a licensed mortgage loan originator to do the origination and have an appraisal and have the closing all be Dodd-Frank compliant?
Yes, and we offer that.
Right, and you are a licensed mortgage loan originator, happens to be, right?
Yes.
There you go.
Rick, just to be clear, this is only if you sell it to an owner occupier.
Yes. If you sell to an investor that doesn't occupy it as a residence, this doesn't apply. However, you should be careful that if they move in at some point, you may be retroactively liable.
How much does a service like this cost to hire a loan officer to do this process?
We charge $1,000 retainer and charge $1,000 per closing for doing that service. And we spend a lot of time educating the consumer. There's normally a series of phone calls, meetings, there's a 50-page disclosure package, and then there's a CD. We absorb the liability of miscommunicated APR, we calculate the ability to repay, we submit it to you as a lender, which is what you are, and then you can condition it for other documents or a cosigner, and then we send it to closing just like we would do anything else. You know, keep in mind this same process is something that we normally make 7 or 8 times more doing, but we want to offer it as a service to the general public because I was there for the MERS debacle. I was called as a witness a couple hundred times to discuss whether or not an Autobot signature created a valid chain of title. And I was there at the end when people asked what happened, and I was like, "You lost," is what happened. So just be cognizant of everything that's there, and eliminate the liability where you can.
If we hired you for something like this, is that per borrower or per property? I mean, if you decline somebody, did we spend $1,000 for that?
No. We would charge a reasonable concession for something like that, which probably would be a couple $100.
What is the maximum origination fee allowed?
3% is the legal answer, but lenders won't let you sign up for more than 2.75% of the loan amount.
And did you say high cost is illegal in residential owner-occupant now?
Yes.
So that means over 10%, essentially, is roughly what you're saying?
That's correct, and more than 3 points.
Well, if the prime goes up, is it?
Yes, it's a factor of prime, so it's at prime plus 6. You guys want some more scenarios? I got a couple more. We're gonna have fun with them. Okay, so let's talk about the difference between brokers and lenders. There's actually not a lot of difference. I've been a broker. I am a broker most of the time. We do lend some on our own. The difference mainly, the front process is about the same, and then when I'm a lender, I will fund the deal through my warehouse line. And then I sell personally on a flow basis to the end investor or lender. There's not much difference. Then you'll have bulk lenders, which will package them in $5 or $10 million bulks. And then you'll have portfolio lenders, which keep their own paper. Licensed loan officers versus unlicensed loan officers. Licensed loan officers are licensed through NMLS and through the state which they're in, unless they're employed by a federal bank. Unlicensed or not licensed. Wholesale and retail operations. I'm retail. I deal directly with the consumer. Martin is wholesale. He only deals with brokers. Debt to income versus debt coverage service ratio. Debt to income is a personal issue. Debt coverage service ratio is simply rental income divided by PITI. Loan to value versus down payment and cash to close. So I think we all know what loan to value is. Down payment is the down payment requirement. Cash to close is the down payment plus the closing costs that you're responsible for minus whatever earnest money. Lender broker fees, closing costs versus impounds and others. Since Dodd-Frank, most brokers are either lender paid or borrower paid. You can't really be a combination of both. So a lot of the game playing has exited the arena there. So we're pretty much fixed pricing on all our deals for all our customers at a fixed percentage. 4 types of mortgage classes, we've gone over that. Yes, sir.
How do you regard rents from short-term rentals like Airbnb?
I mean, it's not owner financing, if that's what you're asking.
No, I mean, sorry, I'm going back to the
DSCR.
DSCR.
Okay. That's tough to document. Have you done one of those? I haven't done one of those.
I've seen it on an exception basis, but you don't really see it that often. I mean, you'd have to show like a history of that, like a 2-year history. You just couldn't have it for like a month or 2 months. Everything that we look at is usually a 2-year pattern. So if once you get to 2 years, then you can probably get us to make an exception to use that. But I have seen what you're talking about. But it's usually for a period of time.
That's a 2-year history of income. That's what they do.
Now, if that's your subject property and the topic of conversation for refinancing or buying, that's a much harder conversation than if you're just trying to leave it off the grid and buy another property. So if that's the subject property of your application, it's going to be a very difficult transaction if you need that income to qualify that property.
Thank you.
Sure. So we've gone over the 4 types of mortgage classes. Here's the different credit types: C, B, A plus, and A++. Here's your prime mortgage matrix. So we made you a copy of this one. We know it's a big pill to swallow. VAs, 100%. Max loan amounts is $424,100. VA cash out refinance is 90%. VA construction, 90%. That's a typo. FHA, 96.5% is the purchase loan to value. FHA cash out refinance is at 85. FHA construction is at 96.5. That's the 203K. It's a fantastic product. Goes up to $659,000 for a 4-unit. 4 units are great. They typically work out lovely on paper. If you have a $659,000 FHA loan, that will typically run you less than $3,000 PITI. If that same 4-unit building is renting for $1,500 per unit, you're looking at over a 2-to-1 debt servicing ratio. That is my, by far, best recommendation for a first-time investor. And we'll go into that scenario next if I haven't lost you guys. Fannie Mae has 2 products. Their standard, which is at 95. Their home ready, which is at 97%. Got to make less than the median household income there. Cash out refinances it at 80%. Fannie Mae investment, 80%. Fannie Mae cash out investments at 70%. Freddie Mac, the self-employed buddy of all self-employed people, 95% LTV. Home Possible's at 97. They came up with that to compete with Fannie Mae's Home Ready. Fannie Mae's Home Ready came up with that to compete with FHA. Investments at 80% purchase, cash out investments at 70%. Max loan amount for a 4-unit for Fannie and Freddie is $815,000, 3 at $656,000, 2 at $543,000. Credit requirements: 7 years out of foreclosure, 4 years out of short sale, 4 years out of a Chapter 7, and 2 years out of a Chapter 13. FHA, 1 year out of a 13, 2 years out of a 7, and 3 years out of a foreclosure. That's not on there. And they will allow 2 times 30. VA is normally 0 times 30, lates on the mortgage. Non-agency elite, brand new product, just came out this year. Their rates are in the 4s, 85% and 80%. 80% is with bank statements. That actually just went up to 85%, and full doc is at 90%. These are a lot of non-prime products. So a lot of people that buy larger houses are going to go bank statement only. You'll see a lot more bank statement products with a lot of money down. So you'll see a lot of 70% LTV loans with 30% down payment up to $2.5 million, 80% with 680 FICOs. The difference between these programs, the Elite and the Plus, might be rate. I would say that on a bank statement program, 90% is possible, 85% is more common, and 80% is relatively easily to obtain. We do loans for foreign nationals at 70%. And of course, everyone has a investor-only program based strictly on debt service coverage ratio.
I was going to add I was just gonna add on the bank statement loans, we see them come into play a lot where people have done such a great job on their tax returns that they can't qualify to buy a doghouse. So what they do is they run a ton of cash to their account. And so, we have all these special rules, but the bottom line is on a personal bank statement loan, 24 months personal bank statement, we'll go 90% to $1 million. On business bank statements, we'll go 85% to $1 million. So we do a lot more than $1 million. But the point is, it's all because the tax returns, when they come to the realtor, they go, here's my tax returns, I make $20,000 a year. They're like, you're not going to buy anything. And so they say, well, let me show you my bank statements, and they're running through, $50,000 a month. They go, let's go. So that's why we see them, is mainly for the tax return. Yeah.
You guys mentioned you guys do loans for foreign nationals. How do you guys deal with foreign assets and foreign income? Can you guys give us details on that?
I can tell you what we do. A lot of ours are stated income for the foreign nationals, as long as you can prove that you've been 2 years business license. We want to see your visa, that it's good for 2 years. And then we want the assets to be here. It's one of the easiest loans to do. We want the assets here in the States 10 days prior to closing. That's pretty much it.
So it doesn't matter, they can wire like 200,000.
Yeah.
Days before closing.
Yeah.
Close the deal.
And it's usually a second home. The LTVs are not that high. They're not as high as a owner-occupied property, and you can only get two types of loans: second home or an investment loan. I'll tell you a real funny, quick story. There's a certain group of people that were buying houses or second homes in the United States a couple of years ago, and they noticed that they weren't defaulting on the loans, they just weren't paying consistently. And I have no reasons why I think it was, but what would happen is they would pay when they were here in the States, but when they went back home, they quit paying. So I used to joke that they only had to pay while they were here. It was kind of like renting a house. So you don't pay if you're not here. But anyway, they were missing a bunch of payments. So what they typically do now is they'll do an automatic draft so that they won't be late on their payments. But they just, the methodology is different. Different cultures, but anyway. Yeah, it's an easy one to do.
Commercial loans, SBA mortgages. So I love SBA. I do a lot of SBA. SBA is 90% loan to value. Their 7A is a fantastic program. It's at prime plus a low margin. It's for owner-occupied businesses only. It's the FHA of the commercial arena, really. I'm out of order. I'm getting tired. It's getting late. So, different types of business loans. So there's residential properties, but you can get a business loan for a residential property. That's a commercial loan. It's a business purpose loan. It's a business loan. Just happens to be on a residential property. So fix and flip is a business loan. Typically those go up to 90% of acquisition and rehab expenses, limited to 70% loan to value of the after repair value. I think we all pretty much know what we're talking about here in this room. Small balance stabilized commercial properties, usually at 70%. It's another category. There's a whole big group of lenders that do those. Those are typically $250 minimum up to $1 million. Large balance commercial, they're usually a max loan to value of 80%, multifamily, non-owner occupied strips, etc. SBA, 85 to 90, has to be for-profit businesses, at least 50% occupied by the owner. SBA has a micro loan. They'll do a $100,000 line of credit relatively easily. Unsecured cash flow loans are available. Self-storage, restaurants, professional organizations, etc. I know Doug does a lot of those multifamily loans, and you're welcome to come up here and tell us about them if you want. And come on up here. I personally love restaurants, strip malls, and things that are 50% owner-occupied, and the small and large balance commercials.
What's the high on
What's the what?
What's the high? What's the threshold? What's the limit?
It's 10 million property value, usually about 8.5 million for the loan itself. But you can get many 7As. When you apply for an SBA loan, they may possibly give you 2 or 3 7A loans. They may give you a 7A on the acquisition of the real estate at 90%. They may give you a 7A on your assets in the building, such as kitchen equipment and things like that. Then they can give you another 7A on your cash flow up to $500,000.
Now, when you say it has to be on or on, you mean the principal has to be involved in the day-to-day operation of the business?
Yeah, at least 51% of it. So if it's a strip mall and you occupy 51% and it's a restaurant or a car wash, then that will qualify for SBA.
Thank you, Rick. My name is Doug Martin, and I run a company called Commercial Lending Outlet with a big focus on multifamily units. Anything that we do smaller than 5+ units, but for the commercial side, it's always 5+ units. In your somewhere between 5 and we'll say 20 units, generally speaking, your loan to value is going to be 75%, very simply, requiring a down payment of 25%. Making that really simple to you is that there's no seller held financing for a second mortgage on these properties either. It's just straight 75%. So don't get the idea that you can get a loan from the lender at 75% and get 25% from the owner. Not going to happen. They're trying to make sure you have skin in the game. On multifamily, once it hits probably $500,000, some of the rules change a little bit. They start loosening up, and then at $750,000 they loosen up again. But we're starting at $1 million to right at $9 million on the loan itself, not the purchase price, but the loan. You can get a non-recourse transferable mortgage, 30-year AM at just approximately 1% above owner occ, if you can believe that. That is how low multifamily has dropped, and it is a terrific product, especially non-recourse. A lot of people come to me saying, well, I can't afford that type of property. That's when you try to get 2 or 3 people together to make this happen. It is a wonderful product. Keep it in mind. That same product is also available on assisted living also. So go find you one.
Can you give your contact info?
Yes, I'd be glad to. Whoops. My name again is Doug Martin, and it's 404-519-7773.
Thank you. You want to give your contact info?
Yeah, okay. I just want to mention one case scenario, just like Rick was mentioning. This is a real scenario. Actually, Rick did the loan for this guy. They had a $24,500 judgment against him and the wife by one of the largest banks, credit card companies, HSBC, and they'd made a couple of errors as far as when the attorney who represented them, we got the judgment, default judgment against them, collected partially about $1,000 by garnishing an account. Well, they neglected to follow the federal regulations as well as state law. So based on that, we leveraged those facts, forced HSBC to go hire attorneys here locally, and one of the most notorious law firms here locally, I won't mention their name, that over-garnishes people's wages and continues pulling money out of their accounts even after it's satisfied. And they forced them to go get a motion, to file a motion to set aside judgment, and the judgment was deleted off both of the reports within a week by the court. So, because the court reports those. My number is 404-484-3441. Name is Sean, S-E-A-N. Again, that number is 404-484-3441. First name is Sean, S-E-A-N. Last name is S-H-A-H-R-E-S-T-A-N-I. It's S-H-A-H-R-E-S-T-A-N-I. I'm a broker associated with Keller Williams Realty. I do the credit repair as well. And my email is metroatlre@gmail.com. That's Metro, ATL like the abbreviation of Atlanta, RE is in real estate @gmail.com.
My name is Doug Dean. Our law firm is Shafritz and Dean. That's S-H-A-F-R-I-T-Z and Dean, LLC. We have 8 offices around Atlanta, 7 attorneys. Our phone number is 404-255-8183.
So, I notice the time is 10 till. We can open it up for questions, or I can go for a couple scenarios, whatever you guys want. Okay. Well, how many new investors do we have in here? Or is this all pretty much experienced guys? New investors? New investors? Just for fun, I'm going to go through this one scenario for new investors, and we'll open it up for questions. Okay? All right. This is an audience participation consulting brief. Joe wants to be a real estate investor. He has $5K monthly income from his full-time job at an accounting firm and currently lives in an apartment with monthly rent of $1,000 per month and has no other reporting bills. $8,000 in checking and no other assets. Found a home with $200K after repair value for $140 purchase price and needs $20,000 in renovations. What should Joe do? Option A, buy the house, move into it, fix it as time permits. B, buy his first fix and flip investment property, sell it and make some money. C, sell the contract for an assignment fee and move on. D, instead buy a quadplex with a 2-to-1 plus DSCR and move into 1 unit. You already know what I'm going to say. Now, first, let me tell you why some of these options are bad ideas. Well, A is a good idea. Buying the house and moving into it and fixing it as time permits is a good option. As an FHA 203K, mini 203K, he has the ability to buy it, fix it as time permits, make some money and sell it. Buy his first fix and flip investment property, sell it. Does not have enough money to do that. Okay? That, and it doesn't meet the criteria. It's not 70% of the ARV, nor does he have enough money to get through his first draw. B is a nightmare waiting to happen. Sell the contract for an assignment fee and move on. It's a good idea if you can sell it, but again, it's not really a great deal, so it's not a viable project. Buy a quadplex with a 2-to-1 DSCR and move on. He probably couldn't afford the quad depending on the price point because 3.5% down. What are you talking about? You're talking about a $300 quad. Talking about a $600 quad. So this is really designed really more to stimulate conversation, but a lot of times I meet new investors and they say I want to be an investor. I say there's no such thing as a new investor. There's a new homeowner. So. A lot of times people put the cart before the horse, want to take their savings and throw it into a project that doesn't have a chance of seeing sunlight. Before you do that, think about the other options that you have. A lot of times they're up here on this board. Any new investors want to ask me anything? If you do, you can always call me and ask me later for a short conversation. Nothing personal. You guys want one more?
Yeah.
Yes.
All right.
Did we get an ice cream afterwards?
You get an ice cream. All right. Dave is a vibrant 65-year-old retiree who lives on a 2K a month Social Security income, has a construction background, wants to be a real estate investor. Again, owns primary residence, free and clear, valued at $500,000. Has no other reporting bills. He loves his home and does not plan to move. 8K in checking, no other assets. Found a home with 200K after repair value. 120 purchase price. Notice I dropped it on this one. And needing 20K in renovation. What should Dave do? All right, option A, get an FHA home equity conversion or reverse mortgage line of credit.
A.
Definitely A. It's probably the best product in the world with the worst reputation. B, buy his fix and flip investment property with the funds from the Heckham and sell it and make some money. No. Well, actually, it's a good, he should do A and B.
That's just step 2 for A.
Yeah. Sell the contract for a small assignment fee, or instead buy a quadplex with a, well, I would say A and B is my answer to this, and then later buy a quad, because my advice to everyone is to buy a quad. I'm slightly partial to quads.
What do you got against a duplex?
Or a tripod.
The other guy could have bought a duplex.
What's wrong with 3?
Well, quads usually have higher DSCRs, and they're more diverse because there's 4 as opposed to 2.
How about the simple answer, there's 3 other people putting in rent.
Yeah.
If you lose one, you only have 3, but 4 is a wonderful thing.
Yes. We're open for discussion, and I'm just going to leave this up, but we are open for discussion.
Can you put up the one with the Photoshop picture of yourself?
No. We do have, here again at the do-it-yourself credit repair class, we're going to, if you need credit repair, you're crazy not to do this, because no one's going to do it for as cheap as we're about to do this. You get it, the $39 is the credit report costs. You'll actually see that. The simulators cost $6 each, and the credit report's like $21. And then we're going to charge you $200 to attend the class. It's December 16th from 10 to 4, and I'm actually hosting it. And everyone in that class is going to get a credit report and a rescore. Go ahead.
Rick, how do you know that you could benefit from something like that if you have good credit? Like, if your credits aren't decent, is that just a waste of time, or is there something you can actually do for people with good credit?
Kind of. If you're over 700, I wouldn't bother. We did Amanda's. She was at 720. We did hers just for fun. And we paid down a credit card to $1, and her score went up to 800. It was crazy. And the collection that I shouldn't be talking about this. This is totally a violation of her financial privacy. But she's a nice girl. I don't think she'll come after me. She had a blemish that we did not pay, and paying it would have dropped her score significantly because it created activity on something that was old. So there's easy answers to all this. I'm not a brilliant guy. It's all through the simulators. Equifax TransUnion Experian has a simulator. They charge $6 for each, and the credit report's like 20. And everyone that comes into that, we'll just give them a credit report, and we'll tell them what the simulator does, and it'll tell you exactly what your score will be when you leave that class. And we'll do everyone's in there, and we'll talk about a few other things. And if we can't fix it, have Sean send a bunch of frivolous letters at them, threaten them to do something that they'll never perform on.
Sometimes the simulator will predict a score that's not necessarily the highest. I can help you get it to. I can get it higher than the simulator a lot of times. So for instance, the simulator says like 650. We could probably get it close to 700, if not above.
I don't know about that.
Yeah.
Or if it's legal for him to even say that.
No, we get.
I'm not clear what you're selling here. You're selling
like
just
400 to like close to 700 or something like that.
just December 16th for $239, or that whole page for $239?
Okay, yeah, December 16th is the credit part. Okay, and it includes a copy of your credit report, simulation, and all three bureaus. So then we're having a tax prep training class, which we're looking for CPAs. We haven't found the CPAs yet, but we're doing a 1-week course for, this should be beginner, intermediate, and advanced. And then, of course, if you take all three, does anyone know how much those are? Where's Laura?
So that's going to be 5 days of doing tax prep?
If you want to do that, yeah. And you may want to do one of them. Like if you're advanced, you may just want to come in for one of them, but it's a lot of information. And then the CPA is going to remain on task for you to bounce off scenarios and prepare things. A lot of people are going to do this as a career path. You know, Kurt's been tasked with getting people careers every now and again, and I felt bad for him for having that burden to bear, and I wanted to jump in with some ideas. So one of them, which is tax preparation, it's a good career path for a lot of people. If you want to learn it for yourself or do it as a career, you know, here's an opportunity. The other thing is mortgage processor training. It's a 6-week course. It starts January 27th. It's going to meet once a week. You know, we're always hiring processors. We're training for that course. Personally, yes, ma'am.
Are you hiring for mortgage lenders and paralegals?
No, we don't. I mean,
Underwriters?
No, we're mostly brokering, but we're always looking for processors. So if anyone's interested in processor training, that starts January 27th, 1 to 5. I know that we're looking for 3 going into next year. So if you think you have the skill set and the commitment, go for that.
Sorry, how much is each one? Is the 239 for the first section? How much for the tax preparation? How much for the mortgage process?
The mortgage processor class is $1,000, and I don't know how much the tax. I'm sorry, I think it's $800, and I don't know how much the tax preparation course is. I didn't actually type this up. Do you guys want to ask Laura if she's available how much the tax preparation class is?
I don't think she knows yet, but it is definitely going to be for sale. It's not included in the 239. It's a separate. I don't think we know. They know.
It's a 1-week course, so it's probably at least $700. I would guess. Maybe 500. I don't know. Check the website. Anybody have any questions for us, and we're going to the bar after this? I am.
Yeah, so the after party is here.
Yeah, the after party is right there in the lobby.
So Rick,
Don't drink and drive, drink and stay.
when you do your SBA prior adjustment,
We do all 50 states SBA. Yeah.
I got some error.
Okay, great. Dee's a real estate attorney, yes. I'm sorry, do we have any more questions? All right, guys, that completes.